Hi guys, welcome back to Compound and Everything. My name is Chris and this is the channel that discusses all things investing, finance and business. If you haven't already, feel free to click that subscribe button and the little notification bell next to it so you can stay up to date on all of our latest videos and market moves. Guys, this is actually going to be a brand new mini series on this channel breaking down all things emerging markets. We'll cover exactly how you can invest in them and which ones you might just want to stay away from. In this, the very first episode of Emerging Markets, I'm going to try and think of a better name there. We're going to start with the world's largest emerging economy, which, as you can see from the title of this video, is China. To kick things off, we'll discuss how they've made the cut, and then I'll show you how you can invest in them. So stick around. Now, like most somewhat speculative investments, developing economies can offer greater returns to investors by rapid growth. But of course, due to the nature of the beast, they can also offer greater exposure to some risk and losses. This video, of course, isn't advice, it's just my personal opinion, and you should do your own research first. So you might actually be thinking, wait, China surely isn't an emerging market. They're massive already. Well, actually, despite being the world's second largest economy and home to the most billionaires, China is still categorized as a developing country and enjoys the same special and differential treatment afforded nations like Papua New Guinea and Zimbabwe. But how exactly is China, with its booming economy and staggering growth, still eligible to keep its developing country status and benefits? And at what stage does it become a developed country like, say, Australia and the United States? Well, believe it or not, it's actually entirely up to the individual countries themselves to self-allocate in or out of these groups. Yes, that's right, China is actually choosing to keep its title as a developing country, at least for now anyway. But like I mentioned above, there are some advantages to being a developing nation. Special provisions in WTO agreements give developing countries more time to implement tariff restrictions and also increase access to foreign markets. Believe it or not, the World Trade Organization, which is the authority in this space, does not actually define a developed or a developing country, nor does it have any benchmarks to determine which bucket its members kind of fall into. So I guess it's kind of just a free-for-all, and China appear to be just taking advantage of that system for now. In saying that, there is no doubt in my mind that China will continue to grow and develop over the next 10 to 50 years. Not to mention, in this time, it's estimated that China may in fact become the world's largest economy. Carrying on from that, within the next 100 years, projections are actually showing China having an economy so large that the closest competitor may actually only be 50% of their weight. And that competitor is probably actually not going to be the USA. It's more likely going to be their neighbor, India, which is projected to surpass the USA at some point in the next 100 years as well. So how exactly can you invest in the Chinese market? Well, of course, there are many ways to invest directly into Chinese securities listed on the Hong Kong Stock Exchange, which has been common practice for many foreign investors in the past. However, the Shanghai Stock Exchange is a completely different story. In the past, this has been a very difficult process for foreign investors to access, if not impossible for most of them. Now, that is mainly due to government regulations in China. However, in saying that, in recent times, Chinese authorities have started to slightly loosen some limitations that were previously in place for foreign investors. And this might just be that crack in the door that we need to try and gain a bit of a headway in that space. In saying that, investing directly can be a little bit tricky depending on if your broker offers that service or not. For those Aussies watching this, I believe that CBA, ANZ, maybe the other two big banks, plus IG and CMC Markets offer this service. However, it's probably a question that might be worth asking your broker just to see if this service is available for you. Now, another way to invest in Chinese companies, and one of the more popular ways, would be via the New York Stock Exchange. Companies Companies like Alibaba, PetroChina, JD.com are all on this list. These, for the most part, are very accessible to Australian investors via most mainstream brokerages. However, considering that we're near 20-year lows, you might just want to hold out and reconsider swapping that Australian currency to US dollars at this point in time. Which then leads me to you using your Australian dollars locally. Like above, you do have the option to invest in Chinese companies locally here in Australia on the ASX. At last report, there are currently around 40 companies on the ASX that have China listed as their principal country of operation. However, respectfully to those companies and to you, I'm just not comfortable in giving you the exact examples of what those securities may be. Mainly because they're just not in the same caliber as what you might find on the New York or Hong Kong stock exchanges. In fact, the ASX kind of has an odd relationship with some of these Chinese listed companies here locally. In 2018, not only did they reject any mainland company's application when listing, they also delisted a further 6 securities, and to date, there hasn't been a huge amount of clarity as to why or what the sort of path is moving forward. Like I said, I do see some very interesting direct investment prospects coming out of Hong Kong directly and also via the USA. I would find it difficult implying that entry-level investors go ahead and try that direct route yet though. Like I said, this can be tricky and may just open you up to more risk than you're comfortable handling. Not to mention, learning the ins and outs of a whole new market might not be something you have the time to do at the moment. If you have decided that you do want to have some exposure to China in your portfolio, you'll probably find it much easier to take the ETF route, at least for the meantime. In this video, I've put together 2 examples for you guys. The first fund comes by the name of iShares China Large-Cap ETF. You can find it using the ticker code IZZ. This is one of the most liquid ETFs investors can use to gain exposure to the Chinese equities market. This particular fund tracks the performance of the largest 50 companies listed on the Hong Kong Stock Exchange. However, one thing to note here is that the management fee, which is around 0.75%, although not classed as expensive, definitely doesn't fall into the low cost category I've mentioned in the past. What's also important to remember here is that this fund is actually just buying another fund. IZZ actually only purchases shares in FXI. Now, FXI is a fund that is listed on the New York Stock Exchange, doing the exact same job as this one, which is holding the largest 50 companies listed on the Hong Kong Stock Exchange, which is where this fund kind of becomes complicated. Why I don't personally consider this fund is really due to a currency conversion nightmare. Let me explain the best I can. It's kind of like fund deception going on here. Now, we start in Hong Kong dollars, which is pegged to the US dollar, because remember that FXI is a fund listed on the New York Stock Exchange, so the people buying that fund would be required to do so in US dollars. However, when they're purchasing the stocks on the Hong Kong Stock Exchange, they're purchasing them in Hong Kong dollars. But the confusion doesn't just stop there, because the Australian version of this fund is just purchasing the US version of this fund. So Australian investors will be directly affected by the daily changes in the Australian dollar, the US dollar, and the Hong Kong dollar. So yes, that means you're going from the Hong Kong dollar to the US dollar and then finally the Australian dollar with no hedging at all. Now, I didn't actually spend the time doing the math on exactly what this might end up costing you in different scenarios. However, I have a feeling it probably isn't something worth considering in our current economic situation with the dollar so low. Not to mention the fundception scenario that we've just discussed. The fund itself doesn't actually have the best returns. They've been reasonably mediocre over the last 5 or so years. Now, of course, past performance or lack thereof does not represent future performance. However, it can be an indicator, especially in situations like this when you have 3 different currencies involved. So look, I'm not going to spend any more time on this fund. I personally don't buy it, and of course, I can't tell you what to do, but I mean, I don't know, I guess maybe this isn't the one for you. Which then takes me to our second option here, which is the Vectors China New Economy ETF. Ticker code is CNEW or CNEW. This fund gives investors a portfolio of the most fundamentally sound companies in China having the best growth prospects in sectors making up the new economy. What that really means by new economy is technology, healthcare, and consumer staples companies. So in a brief summary, the New Economy Index aims to select the 120 biggest companies in China with the best growth at a reasonable price. Companies are chosen based on the strength indicators across 4 different categories, which are growth, value, profitability, and cash flow. Now, of course, like the previous fund and most emerging market ETFs, this one cannot be classed as low cost, coming in at a whopping 0.95% management fee, which, to be honest, from my standpoint, is pretty disappointing, as most of my basic research I completed when I was putting together this video showed that this fund actually seemed to have a reasonably promising aspect to it. And I mean, it might be one to watch. ETF management fees are sometimes reduced as the fund grows older and becomes a little less time consuming to manage. Moving on from that, like I said earlier in the video, it would be a bold move to bet against China's growth over the next century. They have a rapidly growing GDP and are very much a shoo-in for being the world's largest economy in the future. Now, of course, that doesn't mean they don't face their own challenges. Debt and poverty are still both very significant issues for the Chinese government and something that will need to be focused on for decades to come. And I mean, unfortunately, investment options via funds to date are few and far between. I guess over the next decade, as China begins to open its doors to foreign investment, I can see more competitive options coming into this region throughout that period. However, until that point, I'll probably be steering clear of this space or keeping any investments to an absolute minimum. Like I said at the start of this video, this is a new series. We are going to be having new videos every month covering emerging markets. And by that, I mean real emerging markets. I don't, to be honest, consider China much of an emerging market myself. It really just seems red tape that holds them in there. This series is all about finding actual emerging markets that haven't broken through yet at all or are just starting to. Once again, guys, thank you for taking the time to watch this video. If you haven't already and you enjoyed the content, please subscribe and press that little notification bell next to it so you can stay up to date on all of our latest videos. Once again, don't forget to smash that like button. It really helps me tame the beast that is the YouTube algorithm. Thanks again, guys. I'll see you soon.